Hello my fellow freedom builders and welcome back to the channel. Today's video is a new video in the series about options. We are going to cover a strategy called covered calls, which is a very versatile and widely used option strategy, and it is one of the more simple option strategies that doesn't take too much knowledge about the option pricing and so on. I should say that the video today is a basic video, so I'm not going in depth with the strategy, and you will need some more training before actually using this. But I hope that after the video today, you'll have a very good grasp of what a covered call is. If you haven't done already, hit the subscribe and like button down there, and we will get on with the video. I said showed in the thumbnail and in the title that you could be using covered calls to double your dividend. And I know this can sound like a bit of a clickbait, but it is actually true. And it is a strategy that a lot of dividend investors are using. Not so much in Denmark, where I'm coming from. Options are not so widely used here. But in the United States and other countries where options are widely used and where the prices for trading them are very low, their covered calls is very popular. Right now in Denmark, where I live, the options are getting a bit cheaper to trade, but they are still a bit too expensive. So I'm testing a couple of different other platforms that I will get back to with some reviews on. Now, just if you haven't seen the video about option basics, and I do recommend that you watch that one, but just to sum up, when we are talking about options, we are talking about insurance and risk transfer. So that if you are buying an option, buying a call option, you're buying a right to buy a stock at a certain date at a certain price. Today we're going to sell stocks, or we're going to talk about selling stocks, and we're going to talk about selling call options, meaning that we now sell the option, we are receiving a premium for that, we are receiving cash flow straight into our account, but we are taking on a risk. Now we have the obligation to sell this stock at a certain price. Now, when we are talking about selling a covered call, it means the word covered means that we own the stock that we sell the call on. Because if you're just selling what we call a naked call, let's say we have a stock. Today I've chosen the AIG here as an example. Right now that is at 31.51. That can change in a second because there are about 5 minutes to the US market opens. But let's just say that we are selling a naked call on the AIG. We are selling it here at a strike price at 35 without owning the stock. Then we receive the premium straight into our pocket. The problem is that if the stock really shoots up, if it goes up to 50, then at the expiration date, at for instance the 19th of June, you will have to sell the stock at 35 to the one that bought the option, even though the stock trades at 50. So you will have to go out and buy a stock for 50, or I should say 100 stocks, because each option contract is 100 stocks. So you would have to go out to spend $5,000 in the market to get 3,500. So you would sit on an enormous loss here if you are selling options naked. So what we are talking about today is selling a covered call, meaning that right now we imagine that we actually own the AIG stock, or we buy it right now and then sell an option on it right away. So when we are talking about a covered call, the risk profile looks like this. And I know if you're new to options, it can seem a bit complex, but the dotted line here, the gray dotted line, that is a risk profile of just owning the stock. Now, in this case, this is a stock, and I should say this is a very good graphic I have from the website Project Options, which is a very good option website you should visit if you want to learn more about options. But in this case, it is a stock that trades at $75. Now, you're selling a call option on this stock, and you receive $3 for the option, meaning that you are having a break even now at $72. The stock right now you bought at 75. You're receiving $3 in option premium, meaning that you can put $300 straight into your pocket. That also means that you have reduced your risk. If the stock price should start to fall, then you will not be losing money until it drops below 72. And when you, if the stock price keeps dropping in price, you can see the stock price down here, then your loss will always be less than if you had just owned the stock. Now, I know this sounds almost too good to be true, and it kind of is, because as in all trading, there is a trade-off. And the trade-off here is that you're limiting your upside, meaning that your downside is getting a bit less and you're getting money in your pocket right now. But if the stock price should shoot up heavily, no matter how far out of my screen it shoots, then you will not be making more than this amount, because you have promised to sell and you have an obligation to sell at this strike price of 80. So no matter what happens, you will have to sell at that price. Of course, you can buy back the option, but that will have gone quite significantly up in price. So, but that is a case for another video, because there are a number of ways you can adjust a position like this. There's rollouts and roll-ups and roll-downs and all sorts of different stuff, but I'll get back to that in a later video. But this is the risk profile of a covered call. You own the stock, and you get money in your pocket right now. You limit your upside, but you also have less risk. All right, so let's take a live example here. As I mentioned, I have taken the AIG here, and as you can see, the market just opened here, but let's just take the numbers that I have from the close yesterday. So what we can see here, I'll just show you a couple of examples. We are looking at an example here where, and that was from May 28th. That is today, but the market just opened. We have an expiration date on the stock, on the option, meaning that it runs out. It expires at June 19th. At that point, we will look at some different scenarios today as to where the price is going. But right now, at least in my example here, the price was at 31.51 US dollars. Meaning that we are owning 100 of these stocks worth $3,151. We are selling a call option now with a strike price of $35, and we receive an option premium of 36 cents. Now that doesn't sound like very much, I know. That is $36 that we receive straight into our account. But AIG are offering a dividend yield at 4.06% right now. And what we can receive just for the next 3 weeks is 1% in option premium. Meaning that in the case that we don't get called, our stock don't get called away, then we receive 1%, and we can do the exact same thing over and over again each and every month. Sometimes we can get 0.5%, sometimes we can get 2%. That depends. I'll show you the different scenarios today. But this is the basic case. Now, of course, a stock can move in a number of different ways. And now it is back just around 31.51 where I used in my case here. But what we're seeing here is that we have the price at 31.51, we have our strike price at 35, and we have our expiration date that I marked with a thick green line here. So what we are aiming for here is that the stock should stay below 35 up until the 19th of June. Now, if you are convinced that you own a stock, the AIG here, if you are convinced that you own a stock that will go straight to the moon here, then you shouldn't be using a covered call. Because as I said, there is a trade-off, and that is that you're limiting your upside. So if you are 100% certain that this will go to 50 or 70 or 100 within the next month, then you should not sell a covered call. But if you are in a place where you're not really sure and you think it'll be going a bit sideways or maybe turning a bit down or at least not explode in price as it has done here, then a covered call is absolutely perfect. So let's take a look at some of the scenarios. Scenario number 1. Let's say that the 19th of June, we have a price at expiration date at 32.51. We'll go back here and we can see that that would be, let's just mark it with a line here, around here. The price will be here at the 19th of June. Now what would we make here then? Well, our calculation looks like this. We get to keep our premium. The option runs out worthless, so we sold it at 36 cents. And now it just runs out worthless, and you get to keep your 36 cents or your $36 on the 100 stocks. So you got to earn the 36 cents. You've also made $1 because the stock went up from 31.51 to 32.51. So you made $1 on the stock. So the profit for the month was $1.36. And that is about 4.31% altogether. But in the video today and in the title, I said how you could double your dividend. And the dividend for this stock was just around 4%. And what you have made just from the option premium this month was 1%. Now, as I mentioned, you cannot do that every month, and there are also some rules, or at least I have some rules when I sell covered calls of not doing it when there is there's some key numbers coming out for the companies and so on. So there are months where I'm not selling covered calls, but it should be fairly possible to do this 4 times in a year at least, making around 1% each time. And that means that you're also receiving your dividend, of course, on 4%, and you have made 4 times 1% here. I should say that I normally make quite a lot more when I'm selling my options on the stock, but that is also in cases where I have no problem with the stock being called away. And I should mention that if the stock gets called away, let's say we are getting close to the expiration day and we are just getting up here at 36 perhaps, and you're getting called away at the 19th, you still have your money that you have received in the premium, and there's no problem in just buying the stock again then, or wait for a little pullback and then buy it again. So this is not really a problem. Of course, it is a bit annoying if it really shoots up 50% and you only get a few of these percentages, but that is, as I said, the trade-off. This is not a magic strategy that will make you double your money every year, not at all. But it is a strategy where you, in good and solid stocks that you don't mind keeping, can make additional monthly income. All right, that was one of the scenarios. The stock went up about $1. Now, another scenario here is that the stock goes down $1 or more, but let's just say $1. Now, you still get to keep your premium of the 36 cents here, but now you have lost $1 on the stock, meaning that your loss for the month is now 64 cents, and that is about 2%. But you would have lost $1 if you had just been holding the stock and not receiving the premium. So what you have actually effectively done here is that you have lowered your average price for the stock buy. So you could actually deduct the 36 cents here from your normal purchase price of the 31.51 and say that is your actual average cost of the stock right now, and that is from there you can calculate your profit and loss. All right, so this is, yeah, we can just look at it at the chart here, just as we did before. It dropped $1 down here, and of course there's not much to say about that. Next month, when we get to the 19th of June here, if it has lost $1, you can just sell a new option and receive some more premium. So I assume that we are here talking about a stock that you wouldn't mind keeping, and that where you have done your analysis and saying this is actually a fairly good stock. All right, then there is the last case here, and that is of course the most annoying case at some sort here. We are saying that the price is going up by a lot. It's going up $5 now. We still get to keep the premium at the 36 cents. But now, instead of making $5, because it went up $5, you're only making $3.49. Because you have a strike price at $35, and that is where your stock is getting called away. So you're making the $3.49, you're making the 36 cents, that equals $3.85, which is actually fairly good, 12.2% in 3 weeks. And of course, let's say the stock went up here somewhere, and you got called away down here at the 35. To be honest, when this happens to me, I'm not getting too annoyed because I have still made 12.2% in 3 weeks, which is not that bad. But of course, this is a cost I'm paying, and that is the upside I'm losing once in a while. So as I said, in the coming videos about covered calls, I'll talk a bit more about some strategies, because if you really want to hang on to this stock, first of all, you might have set your strike price a bit higher. You said, well, it might go up a bit, so I will sell or I'll have my strike price here at $37 maybe. I'm pretty sure it'll not go up 20% here for the next 3 weeks. Well, then you might only be receiving something like 12 cents in option premium. But that is okay. That is still 0.3% for the month. And if you can do that for 12 months, well, then you have actually doubled your dividend yield, because that will equals just around 4%. And picking these way out of the money, as they're called, way out of the money calls here should make it fairly safe to say that you're not getting called away. And if you are getting called away, you're making 20% on your stock in just 3 weeks here, and that is not too bad as well. So just to sum up, what we are doing today is we are selling call options, so we are obligated to sell the stock at a certain price. And in any other cases, except from the case where it really shoots up, in any other cases, as you can see here, if it goes straight up to our strike price, if it goes here, if it drops down here, all of these cases, we are actually doing better than by just holding the stock here. It is just in the case where the stock is shooting up really, really hard that we can actually lose some money. And it's not really money we are losing, not out of our pocket, but we are losing the upside. And you should be aware that that is also actually something you lose, because you're taking a risk owning a stock. So when you're giving up some of the upside, that is actually a part of the risk scenario. I hope this made sense, my explanation of the covered call. If you have questions for me, please feel free to ask them in the comment section. Write to me on Facebook, and I'll return shortly with some more option strategy videos. If you haven't done already, remember to subscribe to my channel. That would really mean a lot to me. Hit the like button down there if you like the video, and I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.